The Satoshi Nakamoto I've studied seems less like a programmer and more like a philosopher with an incredibly strong grasp of economics. Yes, a philosopher. So once you grasp the principles behind Bitcoin mining, you can trace Satoshi Nakamoto's thought process, and it's truly an intellect that reached astonishing heights. Because of its peculiar system, when the price of Bitcoin goes up, a lot more money flows into mining. It's strange, isn't it? So when the Bitcoin price rises, miners don't get richer. The mining competition intensifies and miners are constantly struggling. Miners are always struggling, and the mining competition just gets more fierce. And when you look at the system as a whole, a lot of money is being spent on mining. And from a muggle's perspective, it devours an enormous amount of electricity. Bitcoin actually wastes more of the world's electricity. When the price of Bitcoin goes up, miners react by plugging in more equipment, new investments pour in. Because they mine more, the amount of Bitcoin mined doesn't increase, but they use a lot more electricity. Globally, the resource of electricity is further invested into Bitcoin mining. So when the Bitcoin price goes up, environmentalists and mainstream observers start worrying that Bitcoin is consuming all the world's electricity and serve as a staff, guiding us through that narrow gorge. They express concerns like this. This is because they intuitively know that Bitcoin is not just like Samsung Electronics stock towards complete renewable energy. This is because they intuitively know that Bitcoin is not just like Samsung Electronics stock. They understand instinctively that when the Bitcoin price rises, that money gets invested into electricity. Due to the convergence of marginal costs, miners react to electricity costs, investing in electricity, and they'll end up consuming all the world's power. So this isn't beneficial to anyone. It simply leads to the waste of resources. If Bitcoin is a waste, if we assume that Bitcoin makes no contribution to humanity, then for something that makes no contribution, it's indeed consuming the world's electricity. You should see it as 1 divided by n of this total area. However, as an aside, even if Bitcoin were to make no contribution whatsoever, because it enables the financialization of electricity, it's something that must be created, even if it didn't exist. This financialization of electricity, even if Bitcoin as a final collateral asset or means of payment holds no intrinsic meaning or seems like mere child's play, as long as it causes no particular harm, it's precisely this attribute that makes the financialization of electricity possible. This will greatly optimize the electricity industry and other similar advancements. That's my argument, though it's an aside. In any case, Bitcoin miners are spending on electricity in response to the price, and that is simply the deployment of global resources. Now, here's where we can gain a remarkable insight. I asked whether Bitcoin, which fell from $80,000 to $40,000, is more stable, or if Bitcoin that rose from $30,000 to $40,000 is more stable. And then I answered that the $40,000 Bitcoin that rose from $30,000 feels good, but is less stable, while the $40,000 Bitcoin that fell from $80,000 is more stable. I explained it this way, right? And after that, I framed it like a Zen koan, saying it's because your blood and sweat are invested in it. I said that to help you understand it intuitively, but I haven't fully explained it until now, have I? Today I'm going to give you that explanation. In your mind, visualize Bitcoin's historical chart. If you recall Bitcoin's past chart, it's surely a chart that consistently trends upwards. So if you think about the entire chart up to now, doesn't it essentially start from zero? So when Bitcoin was at $0, how much electricity cost did miners pay? That's right, they paid $0. Then when Bitcoin was $1, how much electricity cost did miners pay? Yes, $1. When Bitcoin was $10, how much did miners spend on to produce one coin? They spent $10, right? Isn't that so? Because if I spend $8 and get $2 in profit, I'll mine even more. So the mining competition will intensely increase. When will it stop? Yes, at $10. The mining competition intensifies, the difficulty level rises, and this competition stops when the electricity cost that miners spend reaches $10. That's why it's $10. But what if the Bitcoin price is $10? While miners are currently spending $13 on electricity to produce Bitcoin, what happens then? Miners pull out their electrical cords, then the difficulty level decreases, and only miners or mining machines that spend just $10 on electricity remain. Only the efficient ones survive. Mining machines that spend $11, $12, or $13, well, they're forced out. So it's $10. It converges to that. The Bitcoin price curve that's in your mind, even though the line keeps trending upward, try shading the area under that wild curve. Don't shade the outside, just shade what's underneath. It will form a shape like a mountain, a real mountain. Just one big mountain rising from it all. Because when you pass it, it reaches $8,000 and so on. If you process this, what you can obtain is the money miners spent on electricity. This means if you convert it a bit further, it's the total amount of electrical power invested in Bitcoin over the past 12 years. What looks like energy loss to the eyes of muggles is actually electricity input. Since we don't view Bitcoin as useless, we should call it an input. Although Bitcoin is code, surprisingly, it's a concentration that encapsulates this enormous area. I mentioned that, didn't I? Electricity has been input into it. It doesn't exist in the form of electricity, but amazingly, electricity has been transformed into abstracted numbers and integrated into it. In the Bitcoin code right now, when you look at Bitcoin, don't just see it as code. If this isn't making sense to you right now, then you should listen carefully. It's really good to grasp this concept. The logic that follows is genuinely important. We have a concept called market capitalization. Isn't it simply the total number of shares issued multiplied by the current share price? So this is the area of a rectangle. It's the same for Bitcoin. Shall we draw a rectangle? You recall that earlier in your mind, you probably visualized an area resembling a Mount Everest, right? Now equally, take the current price. What is it today? $46,000. $46,000 is the current price. Now multiply the current price by the total supply of Bitcoin issued to date. You get the area of a rectangle. This rectangular area is the market capitalization of Bitcoin. It's genuinely calculated this way. So you can now compare the integral you calculated earlier, the area of the integral representing the mountain range, with the area of this rectangle, right? You can calculate the ratio of the area of the integral to the area of this rectangle. I believe the ratio is also important, but let's just subtract it. How do we subtract it? From the area of this rectangle, let's subtract the integrated area of this mountain range. When you subtract this, you get a value that is, of course, not straightforward. This isn't about trading volume. It should be about the issued supply. So one is a rectangle and the other is an irregularly shaped mountain range. If you subtract this, you get a rather bizarre answer. It's the profit of the miners. It's the miners' profit. This is also unrealized profit. The unrealized profit of miners emerges. The inner area of this mountain range is precisely the amount miners have spent on electricity so far, isn't it? It's the marginal cost, right? Fixed costs aren't included here. It's purely electricity cost. It's factored in, isn't it? But this rectangle, our hypothetical Bitcoin current price of $46,000 multiplied by the 18 million coins issued so far. If you subtract exactly this price, this is not your profit as a miner. It's the profit that miners have obtained. So then what is the profit you have gained so far? The profit you obtained is by taking from someone else. So it's a zero-sum game. For those of us who aren't miners, we're simply playing a zero-sum game. If I profit, someone else incurs a loss. That's the nature of this game. The only thing that is meaningful in this system is when miners, having spent on electricity all this time, liquidate all their holdings at the current price. If you subtract the money I've invested in mining so far from that price, that becomes the profit I've earned to date. With this profit, you have to pay for the depreciated cost of your machines and cover your own opportunity costs. This includes calculating things like not being in a large corporation and not receiving a salary, but rather jumping into the mining business. That's what you calculate. So Bitcoin has these subtle complexities hidden within it. But now consider this. Let's go back to last March, when Bitcoin was $80,000. What about the rectangle when Bitcoin was $80,000? The rectangle from this integral value, the peak of the integral, this is very intuitive, isn't it? It's just drawing a rectangle from the peak. And since this is an area, and this peak represents the highest price, and that also means it's the maximum electricity cost, you'll see some empty space under the price line above the cost line. That empty space represents the miner's profit. Do miners want to realize these profits or not? I've earned enough money now. I want to buy a luxury bag. I want to impress my wife. And I start thinking about diamond rings, yachts, and Lamborghinis. So what will miners do? They'll dump their profits. What will happen to the price? It will fall. But what if there's a crash that brings it down to $30,000? Like last month, there will be a rectangle at $30,000. Comparing that rectangle at $30,000 with the integrated value that rose to $8,000 because it was pulled up to $8,000. There's a very large area in this integral value that's above $30,000. So because it was mined so cheaply in the past, if you conceptually bury this area, it becomes almost identical. Miners have no profit or a small profit, or their accumulated profit is extremely stable within the system. I think this model can be formalized and used if you turn this into an index. But Satoshi Nakamoto knew this. It's implied in his writings and such. His disciples probably didn't know because they hadn't studied the humanities. But I sensed that Satoshi Nakamoto knew. However, what truly gave me goosebumps about Satoshi Nakamoto wasn't just this. I was genuinely creeped out. Take a look. Bitcoin's price is soaring. When the Bitcoin price goes up, Bitcoin's market capitalization increases enormously compared to the electricity costs incurred by miners. Whenever the peak hits an all-time high, meaning it reaches its maximum ever, though market cap is an abstract concept, miners all believe they've made enormous profits. There's this much empty space, right? The system becomes very unstable, so it needs to be lowered. And when you lower it, the market cap, the rectangle, suddenly drops sharply, and because of what went up, this area of empty space fills in the profits miners made in the past. Let's consider gold. Gold wouldn't show this kind of graph. Surprisingly, because gold has been around for so long, the costs incurred by miners and the price of gold are almost identical to the current price. They are nearly the same. This is because gold's price hasn't fluctuated much, and as it followed the lines of fluctuation, it has come to this point. Unlike Bitcoin, where the area surges up and then dramatically falls, there's none of that. It almost converges, and miners' profits are either very thin, or they even incur losses, bringing it to a near convergence. This is because it's so old. That's why Mises made such assessments about gold. He made these evaluations. So Mises also knew this. Although he may not have conceptualized it with graphs, he still managed to articulate it. But what truly gave me goosebumps about Satoshi Nakamoto wasn't this. Who on earth is Satoshi Nakamoto? This isn't economics nor philosophy. What is this? The thought that came to me was this. Satoshi Nakamoto attached a miner to this system and investors like you and me. This is a single system. It has a human ecosystem around this code. So because ecosystem exists, it cannot be explained by technological advancement alone. Just because technology advances, Bitcoin isn't immediately obsoleted. That doesn't happen. Of course, that technology isn't even necessarily superior, and even if it were, these investors and miners won't simply migrate en masse. Up to this point, I understood it initially, but the part that gave me goosebumps was this. While I was conceptualizing this graph, I had a thought, oh wow, the people around us are Muggle family members, they keep attacking us. And then when it seems like Bitcoin's price might go up, there are those fear-mongering journalists, the mainstream media, the traditional economists. These are the skeptics. They poke and attack. But Satoshi Nakamoto devised this system even considering these people. He designed the system. You might find this hard to believe, right? I found it hard to believe too. I wondered, could Satoshi Nakamoto really have thought of this? Was this intended? But I think it's true that Satoshi Nakamoto intended it. At the very least, he knew it. It's not that he intentionally incorporated it into the design, but he seems to have foreseen it after designing it himself. These skeptics are the #1 contributors to keeping the Bitcoin system healthy. Think about it. If the Bitcoin price keeps rising, if the Bitcoin price continues to climb, the market capitalization of Bitcoin, which is its price, will increasingly diverge from the electricity costs incurred by Bitcoin miners, right? That gap will widen. Then it could collapse if things go wrong. So it needs to be brought down. When skeptics instill fear, the market cap sharply decreases, and the area representing the costs miners spent then pushes up through the market cap, and the system becomes stable again. This holds true conceptually and is reflected in reality. In other words, it's a good state when miners can't afford Lamborghinis. When did this actually happen? In 2017, when the market was booming, there was a Bitcoin or blockchain conference in New York, and what did they do? That was the peak. So they lined up dozens of Lamborghinis on the streets of New York to show off. Dozens of them, parked in a row. News like that came out. What that news signifies is that the gap in this area had widened. So, overall, for us, for people like you and me, we are playing a zero-sum game. While we were playing a zero-sum game, the core of the system was generally making money. They were driving Lamborghinis. This is not a good thing. The gap had widened even further, right? So it collapsed in January and February 2018, right? So the miners, meaning it's purely that the miners who are consuming the capital and resources of this system, being a little less happy is good for the system as a whole. So ideally, like gold, if the current price were to be set and remain stable for 10 years, the costs incurred by miners and the market cap would become identical, but that's difficult to achieve due to psychological effects. So it has to go up and then come down to a certain extent. So this model I'm explaining is quite simple, and it would need significant changes to be written as a paper. Regardless, the core concept remains the same. When you look at it with this concept, if you see the price rising endlessly, that area becomes incredibly distant. The amount of money that participants believe they've earned in this system becomes too large compared to the actual cost spent on it. Then Lamborghinis start appearing, driving all over the place. That's when it becomes dangerous. That's what's important. The point of what I'm saying today is this. When the price went from 8,000 to 4,000 and then to 3,000, you should have been happy. Right now, it's still a stage where you can be happy, right? Because miners are still stuck at that 8,000 peak. But if it breaks through 8,000, then 100 million, then 200 million, and just keeps going. If the skeptics lose their power and it just keeps going, it's heading towards collapse. So it's necessary for skeptics to bark appropriately. That's how it stabilizes over a longer period. So at the same price range, it stabilizes over time. Because when the price doesn't move much and time goes on, miners don't gain much profit. All right, that's all for today. Your heads must be aching, right? Yes, I'll see you next time. Have a great day.